Hey, Alpha fam, welcome back to another episode of Alpha Commission. Today on Alpha Commission, of course, I want to talk about all the green on the charts because Bitcoin did actually break through the critical support level that I designated this weekend as the volatility tipping point, which was that $33,300. And in putting in 4-hour candles above $33,300, the volatility shifted to the upside, and we saw some explosive gains not only on Bitcoin but also on many of your favorite cryptos. Of course, this does come slightly separate from the 8-hour volatility, which itself is starting to pop up. But remember, the 8-hour volatility often has a fake out, and so what will determine over this next week is whether or not the 4-hour is providing that fake out that may lead into an 8-hour dump on the weekly, right? As 8-hour charts play out over multiple 8-hour candles, it can take many days to play out. So, guys, let's just jump to it. Of course, you see these gains pretty evenly distributed here. Flow taking up a little bit of the a little bit of the market by itself there, but as you can see, some of our favorites like KDA just popping off 17%, and so the market looks really robust today, and you will be glad to have taken that risk if you saw that price was pushing at $23,300 on Bitcoin, because of course that was the tipping point that I suggested that things would turn green. Of course, stocks, did close last week in the red, largely in the tech sector, but these, profit taking doesn't seem very convincing yet, and we have to see if this week, if they decide to take heavier profits, and if the tech sector takes heavier profits this week, that's going to probably spell bad news for crypto. On the other hand, if you see these tech stocks start turning green, then most likely crypto is going to benefit as well. So we are just waiting for the trading week to open up so that we can take a look at what stocks may do. Let's see, if we look at the market, of course, you can see that we do have a 3-year inflation expectations, to be put out by the New York Fed. If these numbers come in good over here by the New York Fed, then perhaps we could see a little bit of a pump in the market, as that would take pressure off expectations for the Federal Reserves to increase interest rates. But if the numbers are bad, maybe it could put a little bit of a wobble in the chart. I think the big issue that we're going to be having this week, though, however, is on Wednesday the 10th, that CPI data that we're really looking forward to. We really want to see what this CPI data entails, and if this is very bad, then it could be what collapses the market. So please pay attention on Wednesday the 10th, because this is far more important than the last Jerome Powell Federal Reserve meeting. This CPI data is going to be influencing what happens in September, and currently the market is pricing in 3 rate cuts in September. But that makes no sense, guys. That makes no sense. Inflation hasn't been fought yet. And so something screwy is going on here. And if you're a little bit confused by the market, don't worry. I mean, I have it pretty straight in my head, but it's very difficult to explain all these moving parts. But just understand primarily that bad news for the economy is good news for the stock market right now, because of this bizarro world that the Federal Reserve, both during the Trump administration and the Biden administration, that they set in motion with that kind of hyper stimulus that really just went to billionaires and transnational globalists. It really is not the stimulus checks to the ordinary people that had any real effect. Their savings are almost gone. It was really the hyper activity of the economy that is now biting us in the butt and coming back in the form of inflation, because you have to pay for that 5 to 9 trillion dollars of business stimulus somehow, right? Because it all went into the coffers of these big companies and of hyper wealthy people who basically bought back their own stocks and then dumped it on our heads at the top of the market. And if you see these kind of summer relief rallies, and also that March to April kind of relief rally that we had, it was largely them just doing it again and doing it again. Okay, they're trying to take profits all these times, and so this could still be a fool's rally, and it could come crashing down on us swift and hard, just like it did in that January to April rally that we had, where people got super bullish towards the end, and then it just fell off a cliff, right? And so, guys, the CPI data is going to be really influential in all of this. I'll explain that more when we come up onto this data. But for right now, I just want you to be aware of the date and to understand that Monday and Tuesday might end up being good trading days, and then Wednesday is going to be something that you should really watch out for. And also be aware if the tech sector starts taking profits during Monday and Tuesday, because as they increasingly take profits, that's going to affect the crypto market, which basically trades like a tech meme stock. Okay. And we can see that most of these earnings reports are in. We do have some guys like Nvidia and whatever who haven't, reported yet. But the big issue here is really, the reason why I'm getting you accustomed to thinking about earnings reports is because the critical ones will be in Q3, the quarter 3 2022 earnings reports. Those are going to set the tone for what happens in September and October. And I don't believe we've reached a bottom of the market yet, and that we won't until, perhaps September to October, if not 2023, and that what we're experiencing is just a relief rally, guys. Okay, so we haven't confirmed a bottom of the market yet, and just don't be a perma bear, don't be a perma bull. Okay, guys, be your clever little alpha monkey selves and be open minded to both directions and just trade the charts as it comes up. But be highly aware that we are in a very precarious situation, as we have, look at this yield curve inversion. It actually exceeded the levels of 1989, right? And is equal to the levels in 2000. And while we're a little bit above 2000's lows right now, we really are in that crazy low area. And that does suggest a very big recession to come. Okay. So just to be aware that we haven't felt the full effects of the recession yet, and that we may not even feel it until 2023. Okay. These things take time. Okay. Right now, what we're feeling is inflation. We're not feeling recession right now, guys. Like a lot of these, political news channels and these political talking heads on, especially conservative radio, they try to just like twist the knife. You know what I mean? Try to twist the knife. I get it. They don't like, this or that party, whatever. Okay. But the point is, we're feeling the effects of inflation right now. We're not feeling the effects of a recession. But what the yield curve inversion is telling us is that a recession is coming, and it's going to be coming by the end of the year, and perhaps we're going to feel it intensely by perhaps 2023. Okay, so don't get it confused. We're experiencing inflation. We're not experiencing recession right now, and it doesn't matter if you call it a technical recession or if you say it's not technically a recession. Blah, blah, blah. The issue is inflation right now. It's not recession right now. The recession is what's going to be the prompt for how deep our lows go in quarter 3, quarter 4, quarter 1, 2023, right? And so as we approach the end of the year, the recession issues will slowly start to overwhelm the inflation issues, and we're probably going to pivot on that narrative. But for right now, we're talking about inflation. It's a really, really important point that you keep this stuff together. And we're also no longer emphasizing the the Fed's interest rates as much because the market had priced in partially a 100 basis points increase during the last Federal Reserve meeting. And of course, the Fed only increased 75 basis points. So what did that mean? We got a pop in the markets. The markets jumped upward because they had expected 100 basis points, or at least a large portion of the market, 40% of the market had expected 100 basis points, to be the increase, and it was only 75 basis points. And that's why anybody should have been able to predict that the market was going to skyrocket, that it was going to jump up. And people who are saying that that it was totally unforeseeable, they just haven't been paying attention to what I've been saying, which is 100 basis points we would have gone down, and 75 basis points we would have gone up. That's how I was able to get bullish in the market on the day of the Federal Reserve. And you have to be able to change your perspective very quickly. And I think a lot of people get locked in disbelief and they tell themselves little stories that it wasn't predictable. But if you pay attention to these crazy, nuanced little macro details, they do tell you what's going to happen. And the Federal Reserve was telling us in advance in very clear ways that it was likely to just increase 75 basis points. And because there's also a midterm elections coming up, that also indicated that they were probably going to go softer, which they usually do during midterm elections. We all know that there's usually a midterms elections kind of market bounce. And if guys, like, this, so if you knew that, why would you be bearish on the market at that moment? You should have positioned yourself in a bullish way. And I don't know how else to emphasize that, but it's just wrong to tell people that it was irresponsible to take a bullish perspective at that moment. No, it was very responsible. It was the correct decision, and it was based on technicals of the market that was actually mathematically based. Okay, it's not like it was just going into a casino, yeah, right, and putting your coins into a casino. That was something that was definitely likely to happen. And so what I'm telling you now is also equally important, that in September and October, it's highly likely that we're going to see another downside in the market. And the reason for that is that the market is now considering, three cuts of interest rates in 2023. And so the market may be trying to price in ahead of time interest rates cuts because of this yield curve inversion. I'm not showing you this for no reason, okay? Guys, you have to pay attention to what I'm saying on these macro sessions, because if you're missing the finer points of these details, you're going to get blindsided. You're going to end up in the wrong position. And so just pay attention to what I'm saying. In September and October, we're going to have a harsh negotiation between switching from the inflation market to the recession market, and that is going to be an inflection point where we negotiate whether the market is correct right now to consider three interest rates cuts, right? If the recession is harsher than what we expected, then probably the market is correct, and maybe we've bottomed out, and maybe the Fed will have to cut rates, and maybe we're actually going to, even have more stimulus from the government as they try to rescue the economy from a collapse under a major global recession, maybe even as maybe China, may have a bank run and all of these things. But if that doesn't end up happening, if China gets its banking under control, its real estate under control, and if U.S. real estate doesn't take the hardest hit, it just takes a soft one to the chin, kind of shakes it off, and if the labor market isn't really affected by, the quote unquote technical recession, then perhaps the Fed will be more aggressive in its rates, and maybe we see that 100 basis points increase in September, October-ish, or maybe even in Q1 in 2023, depending how they decide to monitor these things. And that could be the actual bottom of the market. That will be the time that we confirm a current bottom, or that we put in a new bottom. Okay, so guys, don't be confused by these things. A lot of guys don't understand what they're talking about when they are mentioning these type of details, and so sometimes they'll find themselves on the wrong side of the trade. And this is a very macro-led moment that we are in the world right now. You have to understand the global political economy. You have to understand the US government. You have to understand the politics of big money, and also how little people are being hurt by this stuff, as we consider, of course, the political dynamic, especially in the United States, but also in China and Europe. Okay, let's move on from this one, because I think what you guys want to see is what's going on in Bitcoin and crypto. And as you can see that I mentioned, we do have this 8-hour signal of volatility that comes up every once in a while. It's only been like 8 or 9 instances. If you consider this one to be part of the bull run, then we ignore it. But if you consider it to be part of the downturn, then it's one of the signals. And in every case, this signal has led to a drop in the market. We're getting that signal right now, but the thing about it is we have to wait for, and that's an 8-hour signal, okay, which can play out clearly over multiple weeks, at least multiple days, as it drives the market down. Multiple days pass by, and then we have a major drop. Multiple days drop. Days drop, days drops, days drops, days drops. It's only been, about a day, right, since we've had that signal actually get initiated, and I want to show you what it looks like. You can see this signal right here. I've done the analysis on it. We've breaking up in a pretty convincing way. Now we could come back down, so I do want to see us get over this 20% level and kind of put in a little bottom there before I can say that the signal is fully activated. But until then, because it could just stretch on, but until then, we should just assume that it's in motion. And right now, we are moving to the upside. So that volatility signal could potentially suggest that this is going to be the first time that signal initiates to the price movement to the upside, right? To the upside. And every single time that we've had this signal, it has resulted in a 10 to 45% move. Okay, so what could we expect out of that type of move if it continues to the upside? Well, we could consider, let's start here where it initiated at. We could consider all the way up to, let's put it at 45, right? That would suggest maxing out at $33,000. That would be an incredibly bullish run for Bitcoin. And I know that there are other channels talking about like 2-day signals or whatnot, but I have analyzed this 8-hour signal during a bear market, and for the bear market, every single time it has initiated, it either goes sideways and then drops, right? These two signals here in orange or yellow, and then all of these teal signals, it just drops. Okay, it just drops and it moves 10 to 45%. And these were a bunch of little like moves, but if you just consider this first one right here altogether, that accounted for a 35% move. And so let's say that we don't get to 45. Let's say that's just kind of an outlier. What would a 35% move be? That would be approximately $31,000. And what would be just kind of an average kind of move of 25%? That would be $28,000. And let's just say that we get kind of a minimum of 10%. That would put us at 10% would put us at $25,000. And look here, guys, $25,000 would be right in line with this ascending wedge, right? And if we do have an ascending wedge, these things have a tendency to break to the downside, and that could initiate us to perhaps retest our lows or put in a higher low on a macro level here, right? So guys, just pay attention that this signal does suggest more upside, okay? Like it does suggest more upside in the current way that it's positioned. But I have a caveat. I have a caveat. We're actually also having a 4-hour signal, which I've also analyzed. And look at this. The 4-hour signal is already halfway through, right? It's already halfway through its movement to the top of this range, although the EMA is really down here. And so we have to wait for it. Maybe we could say that it's a third of the way if we just kind of average the two positions of these, right? So what I want to see from this 4-hour signal is something like this, and then when they cross, I'll know that the signal is over, right? But currently we have a 4-hour signal, which could be a fake out on the 8-hour signal. So what if, okay, just to hear me out, what if the 4-hour signal is just a fake out where it pumps us up maybe to that 25,000, maybe to 28,000. Okay, let's just say, okay. And then it tops out, right? The 4-hour signal tops out. And then what if it turns around? Then what you could see is that on this 8-hour signal, that would be highly in line with a U-shape fake out to the upside before a harsh movement downwards. If we look at all of these 8-hour signals, almost every single one of them comes with a fake out to the upside. We had a signal here, and that had a move of 10% to the upside. We had a signal here, and it just dropped down. So they either have a fake out or they have a drop down. That's the key point, okay? And so here we had a signal in this area, and the key point is that there was a little bit of a push up of about 5%. Here we had a little bit of a push up of approximately 5%. Here we had a push up of approximately 10%. Here we had a push up of approximately 5%, right? Here we had a push up of approximately 5%. Here we had a push up of approximately 5%. Here we had a push up of approximately 10%. So could we get a 5 to 10% push up on the 4-hour signal, and then that was a fake out for the 8-hour signal to be initiated perhaps to the downside, consistent with its months and months long modus operandi ever since the top of the market? Well, it's highly possible. And right now, we have had a 5% push. 10% would take us to the top of this ascending wedge, which could break down to the downside. And if we push higher than that, that would take us out of the range of the normal fake out, right? That would be highly unusual for us to have a fake out larger than that. Although we did have this one, which was 14%, it was at the top of the market. And so it really wasn't consistent with the bear market. But even if we consider 15%, right, we could consider that we might pull back around that 25 to $26,000 area. It could be the fake out to the upside before the market has that 8-hour signal that's been consistent, a consistent volatility move to the downside, right? 35% down, 10% down, 16% down, 25% down, 19% down, 35% down, 45% down. Every time this signal flashes, we have a move like that, and we did flash that signal, and now we're having a pump to the upside and a fake out. A fake out, a U-shaped fake out, has always been part of that move, except once where it just dumped straight down. Okay, and so if in this case, if we do have a pump up and it makes a U shape to the downside, don't be surprised. You've been warned. On the other hand, if the 4-hour momentum can continue to keep the 8-hour momentum rising, then what will happen is that we can perhaps assume that the 8-hour signal will continue to the upside, especially as we consider some of these other signals on the on multi days. Let's see what else do we have going on here. Well, the 2-hour signal or the 2-day signal already played out, so I don't know what some of these other channels are talking about in terms of the 2-day. Maybe there's a Okay, here we go. On the daily, there's actually a daily signal that's about to be developed. We would have to wait for its EMA to come down here. And so this one is going to be something that we have to watch out for because we're going to have the 4-hour signal dissipating. It's going to complete its move. And then what's going to happen is that a daily signal is going to initiate. And so I'll have to do analysis on the daily signal, but we're not there yet. So that could mean that this is going to be either supporting or it could actually reject the 4-hour and the 8-hour moves. And so we have lots of volatility building up on these different time frames. Let me just see if there's anything on an ultra large time frame that I may have missed. Nope, it looks like we're primarily dealing with the daily as this is approaching an extreme low. It should hit sometime this week, and then that's going to be a very, very key issue to pay attention to. Please remind me if I forget about that one. And it's going to pivot around $23,000. So again, that $23,000 is so critical, guys. Super critical. The 8-hour also has a pivot around 23,000. Let's just say 500, and let's go to the 4-hour. The 4-hour continues to pivot around 23,500. So in all of these cases, as long as we're above 23,500, we are in pretty good shape. And what was I warning you guys of on the weekend? I was warning you we had to get above that 23,300 if we wanted to see that pump to the upside. And if we had broken down from 23,000, we could have plunged to hell as all of those volatility, the 4-hour and then the 8-hour and then the daily volatility would have just pushed us down into the depths of hell. So don't think that those warnings are not important. Volatility is direction neutral. We have to measure the momentum at the time of the breakouts and as these candles start printing and closing. It's important to have multiple candles close. We now have 2 candles to the upside, and that's making me feel pretty safe that the 4-hour is playing out to the upside. But this hasn't secured the 8-hour yet, okay? It does suggest the 8-hour probably is also playing to the upside, which is why I'm giving you that type of a stretch goal target now for Bitcoin, even though we have this ascending wedge, and even though I can suggest there is some risk that we could get deflected here in our ascending wedge, or pardon me, in our accumulation wedge, but I would say it's not likely, especially given what altcoins are doing. Right? And then there's also a chance for us to get deflected in our ascending wedge here, right? Which does have a tendency to break to the downside, but giving it just the benefit of the doubt that maybe the 8-hour can push us through this, then our stretch goal is really going to be in this area. And you understand it has a huge range, guys. It has a range anywhere from 33,000 to even that 26,000. So, take this, target with a grain of salt. sometimes when you have a little bit of a bull run, some type of a parabolic phase, you can't be quite sure where you're going to end up because things are just going parabolic, right? Sort of like this drop. You can't 100% predict exactly which level you're going to hit. And in reality, you kind of like chop around and negotiate the price, right? So probably we're going to push up, meet some resistances, we're going to negotiate the price, and at some point we're going to limit ourselves, probably in this area. But it's looking good. Okay, it's looking good. And what I would like to see next is for us to close an 8-hour candle above 24,000, something that we just haven't been able to do. Here, rejected, 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 rejected. We really tried rejected, rejected, right? And we're rejecting again. So we need an 8-hour candle, to close above 24,000, and that will give us the confidence that we need to suggest that that 8-hour volatility is likely to play out to the upside. But then we have to be super aware that we have that inflation data coming out, we have that core CPI data coming out, and so that could just knock us on our butts as the daily, right? As the daily volatility builds up, and as we bypass this 8-hour signal, right? We had like a little baby 4-hour signal, and we have an 8-hour signal coming up, and pretty soon we're going to have a daily signal that's going to come up, probably in the midweek around that CPI data time, or perhaps at the end of the week, and that one could be the one that smacks us down and tells the 8-hour and the 4-hour to just stop doing whatever they're doing, okay? If they are pushing to the upside, this could be the limiter. And on the other hand, if momentum is to the upside, especially in stocks, then the daily could say, let's go for it, guys. Let's rocket to outer space. Put on your space helmets, right? Become a moon whale because we're going to swim to the moon, guys. And, so we're really going to try to pay attention to this signal. I underscore these things and I mention it multiple times only so that you guys understand, the importance of these moments. Not every trading day, not every trading week is as important as this one, okay? We have very rare signals in the last half year, right? In over half a year, we have only had 8 of these signals. And for the daily, we've only had one, almost two, right? But here, two, three. We've only had 3 of those signals on the daily, right? Since in the last, basically, 9 months, we could say, right? Well, actually, yeah, I mean, in the last 9 months, we've only had 3 of those signals, and you could consider 5 if you count this extremely high volatility, but coming from a low volatility point is just a slightly different thing than coming from high volatility. So the fact that we are about to initiate another one of those signals, you have to pay attention this week. You just have to pay attention. And let's go ahead and just look to see if we can find any divergences on our RSI here. So let's talk about the 1 hour. It doesn't look like anything too important right now. Just like pop through these ones. We do have quite a shift there, right? Where you see this is kind of equal or above, right? You can see that once we get to the 4-hour, we're starting to see lower, right? So I mean, we don't know where we're going to top out, but we could potentially have some type of interesting divergence building up here, perhaps a negative one. But let's find out. Let's see how these things play out. And the 6-hour, pardon me, the 16-hour has this bullish divergence, which I did mention to the group. I did mention that we had a 16-hour bullish divergence building up, and you can see that we have just popped off of that divergence. And so that has been a very interesting move, and that will be confirmed with the close of this candle if we hold a pretty relative position. And so that bullishness could continue to perhaps drive us. But guys, I think I'm going to leave it there. We still know that that 23,000 and 24,000 are really critical areas for us. We have to break 24,000. We have to maintain above 23,500. And so if we can keep above these critical areas, then we should be relatively safe. But if you do see us violating this zone, then you're going to want to just take some precautions, as the market could be moving in the other direction. And one of the things that we have to consider when we look at that is that the stock market is getting very, very toppy. And of course, we have already topped out on the stock market in terms of our downtrend. This is a natural place to take profits, right? For the market to dump down. And so over the next couple days, the market may decide to increasingly take profits, and it could dump us down pretty hard. But if we switch over to the log chart, you can see that if traders decide to just like squeak a little bit of bullishness out of the market, they could be on the log chart, the logarithmic version of the chart, okay, which just takes into, takes exponentials into consideration. And so maybe they're going to just kind of fudge the trend, just kind of fudge the trend a little bit to the top side, and maybe we could find ourselves, topping out in this area of the QQQ, the Nasdaq 100, the Nasdaq, pardon me, somewhere around 330-ish, let's say. If we're talking about the Nas 100, maybe that could be 13,600. If we're talking about the SPY, the S&P 500, then perhaps that could be as much as, let's see here, let's get a nice trend off of that one. Perhaps that could be as much as this 430 area. And let's look at the futures, S&P futures, right, that $4,300 area. And the Dow Jones is kind of, right there as well. And so we could suggest something like 33,800 if this market pushes up. Okay, I'm not saying this is what I project. I'm saying if the market pushes up, and that's of course all based upon just I look at what the Russell 2000 is doing. It broke its downtrend, and although it's meeting resistance, it is still considering to push up. So the Russell 2000 is showing us the way. And again, guys, I think this is a little bit too much bullishness. I think the market is kicking itself in the pants right now and stepping on its own feet, and that at some point this rally is going to backfire, especially as we get towards mid-August and September. And then definitely by October, there could be just a major dump as the inflation narrative comes head to head with the recession narrative. And as all of this has to get parsed together, we could see a double bottom on the charts, or we could see a new low, an actual low to the market, where finally the market figures out what's going on. Okay. So take everything with a grain of salt. Don't forget to take your profits along the way. You can buy back in on retraces, but don't forget to take your profits along the way. Always be selling in a macro downtrend, and don't be a perma bull. Don't be a perma bear. Just be a smart little alpha monkey, and it should carry us home. Of course, we are seeing coins like KDA just reaching our previous targets, and so I've had to move the stretch goals up. We're doing very good in these trades, and one thing that I forgot to mention in our KDA video that I just put out earlier this morning is that if stocks do end up topping out and we do have a pullback, some buyback zones that I would suggest is perhaps this $1.80 or perhaps $2.15 zones, which might conform to this kind of curve that we have. That would still be a fairly bullish look. Okay, guys, that's your alpha for the day. Stay safe and happy trading.